Welcome to MARKETSnap Educational Series, an easy and convenient way of learning basic concepts about investing and financial markets, all explained in an easy and accessible form. The series starts with the basics of investing part. In this sixth video, we will learn about the 3 pillars that drive investment returns. So, ultimately, how stocks make money for you. What are the 3 pillars? If you're a stock investor, there are 3 main factors that should be on your checklist before you invest, as they can significantly enhance your returns. Each of these is a crucial component that can contribute to the returns you receive from owning stocks. They represent the rise in the stock's price, the profits that the company distributes to its shareholders, and the actions taken by the company to bolster its stock value. By understanding these components, you can gain a clearer perspective on how your stocks might perform, and it can assist in shaping your investing strategies. Now, let's dive in and examine each of these components in more detail. First pillar: capital appreciation. Capital appreciation is simply the increase in the value of an asset. It is the main key driver of returns for investors for most asset classes, especially stocks. This can happen for a number of reasons, but there's only one that really matters: earnings growth. Investors are willing to pay more for shares of companies with strong earnings growth, as this is clearly a sign that a company is becoming potentially more profitable and valuable. Capital gain can also be caused by other factors, such as investor sentiment for the overall stock market, which can drive up prices, or valuation expansion, which occurs when the price of a stock increases faster than its earnings. And this can happen due to a number of factors, for example, increased optimism about the company's future prospects. Sentiment and optimism can flip easily, and the stock market can follow suit. So, again, if you're a long-term investor, never invest based on short-term news and sentiment. Instead, focus on understanding the growth potential of the company you're considering. But how do we measure this potential? Let's turn to the wisdom of Peter Lynch, one of the greatest investors of all time, to guide us through this process. He managed the Magellan Fund at Fidelity Investments from 1977 to 1990, during which time the fund achieved an average annual return of nearly 30%. A remarkable performance, more than twice what the S&P 500 earned during that time. Peter Lynch's investment philosophy is often summarized by his slogan, "Buy what you know." He believes that individual investors can outperform Wall Street professionals by investing in companies they are familiar with and understand. But the most important aspect of his investment style was his focus on earnings growth. He believed that earnings growth is the most important factor in stock performance, and that investors should focus on finding companies with strong earnings growth potential, at a reasonable price, and holding onto them for the long term, rather than trying to time the market. Lynch developed an investment strategy that is commonly known as growth at a reasonable price, GARP, which combines elements of both growth and value investing. Along with the GARP strategy, he also created the PEG ratio, a revised version of the PE ratio valuation that factors in a company's projected earnings growth rate, and which remains one of the most important valuation ratios today. Don't worry, if all these ratios sound confusing, I'll explain in detail all types of valuation methods in the next part of the educational series, called How to Value Stocks. So, stay tuned. But since this is still the basics of investing part, let's keep it simple. And let's keep rolling with the 3 pillars of how stocks make money for you. Lynch's approach has had a significant influence on the investing community. His success demonstrated the potential of growth investing, and his books, including One Up on Wall Street, have educated countless investors about his philosophy and approach. As someone who is not affiliated in any way, I'd still highly recommend One Up on Wall Street to any wannabe investor. This book is not just a recounting of Lynch's successful strategies, but also a truly paramount guide that can equip you with the knowledge and tools necessary for effective investing. Second pillar: dividends. Dividends are a distribution of profits by a corporation to its shareholders. When a corporation earns a profit, or surplus, it is able to pay a portion of the profit as a dividend to shareholders. If a company chooses to pay dividends, they may be distributed monthly, quarterly, or annually, and the amount of dividend an investor receives is proportional to the number of shares they own. Any amount not distributed is taken to be reinvested in the business, called retained earnings. Dividends are more often paid by large, well-established, low-growth organizations, with less need for reinvestment, and are popular with investors, as they provide a steady stream of income, in addition to any potential capital gains. This makes them particularly attractive for income-focused investors, such as retirees. However, not all companies pay dividends. Some companies may choose to retain their earnings for reinvestment back into the business rather than distributing them as dividends. This is often the case with growth companies that prefer to reinvest their profits to accelerate growth. Also, dividends can sometimes be seen as a less favorable strategy for companies due to the double taxation issue. This is because dividends are paid out of after-tax profits of the company, and then the individual shareholders must also pay taxes on the dividends they receive. Additionally, if a company's stock is undervalued, it might make more financial sense for the company to buy back its own shares rather than pay dividends. We'll see share buyback in just a minute, but for now, they can increase earnings per share and potentially boost the stock's price. This could be particularly beneficial if the company has strong future prospects and believes its stock is currently undervalued. Third pillar: share buybacks. A share repurchase, or buyback, is a decision by a company to buy back its own outstanding shares from the market. Companies buy back shares for a number of reasons, such as to increase the value of remaining shares available by reducing the supply, or to prevent other shareholders from taking a controlling stake, or a company might buy back its shares because management considers them undervalued. A repurchase, by reducing the number of shares outstanding, it positively inflates earnings per share, and often, the value of the stock. A share buyback can demonstrate to investors that the business has sufficient cash set aside for emergencies and a low probability of economic troubles. Another reason for a buyback is for compensation purposes. Companies often award their employees and management with stock rewards and stock options. When a company issues stock-based compensation, it can lead to share dilution for existing shareholders. This is because new shares are created and given to employees, which increases the total number of shares outstanding. To counteract this dilution, companies can use share buybacks. And by the way, speaking of dilution, companies may choose to dilute their stocks for other reasons, such as to raise additional capital. But share dilution reduces the ownership percentage of existing shareholders, and this can lead to each share becoming less valuable. So, while the potential for capital loss is often readily apparent when considering capital appreciation, while dividends are straightforward, a company either pays the dividend or doesn't, meaning that even in the worst case there aren't downsides or losses of value in your investment. The concept of share dilution can be more elusive, particularly for those new to investing. It's important to be aware that dilution, though less obvious, can significantly impact the value of your investment. And while dilution is not always a negative if the funds raised from issuing new shares are used effectively and lead to company growth and increased share value over time, it's crucial for investors to be aware of this aspect and understand why and how a company is diluting its shares. Remember, as an investor, you own a part of the company, not just a ticker symbol, so it's important to know what the management is doing. That's why, as a shareholder, it's important to follow conference calls and know how to read financial statements. And if you don't know how to do it, well, keep following MARKETSnap. I'll have other videos where I explain how to read financial statements, and everything else there is to know more in detail about share buybacks and dividends. Wrapping up, it's clear that the pillars of investing, capital appreciation, dividends, and share repurchases, are integral to making savvy investment decisions. By grasping these concepts, you're well on your way to navigating the financial markets with confidence. I appreciate you tuning in and hope this information has been valuable. If so, I encourage you to like, share, and subscribe to stay updated with every day's convenient MARKETSnap overview and more from the educational series. See you on the next video.